DSCR loan rates and conventional mortgage rates jumped 14 basis points this week, with the 30-year fix climbing from 5.99% on Friday to 6.13% by Thursday, firmly erasing last week's brief dip below 6%. We touched sub 6% for only a moment, and the market snatched it right back. Here's why that window closed so fast and what it means for your next rental property deal. And if you stay until the end, I am going to show you exactly how keeping your DSCR ratio above 1.2 can slash your DSCR loan rates by 25 to 50 basis points, even in this stubbornly sticky 6% environment. The great escape that wasn't. Why sub 6% rates lasted exactly 1 week. On February 27, the 30-year fix hit 5.99%, the first time rates crossed below 6% in months, and real estate investors were starting to get excited. Then Monday happened. Mortgage News Daily reported rates jumping immediately back into the low 6% range on March 2nd, driven by firming treasury yields as investors reassessed how aggressively the Fed would cut this year. The 2026 housing market shock isn't that rates are high. It is that every time they dip, something pulls them right back up. For DSCR investors who are watching this closely, the lesson is clear. Don't wait for a sustained sub 6% environment that the bond market keeps refusing to deliver. If a deal pencils at today's rates, structure it today, because the next dip might be just as brief. Freddie Mac confirms it. 6% is the new floor, not the ceiling. On March 5th, Freddie Mac released its primary mortgage market survey showing the 30-year fixed at 6%, up 2 basis points from the prior week, and noted that 1 year ago rates were sitting at 6.76%. Here is what that data point is really telling you. We have come down meaningful from 2025 highs, but the market isn't giving us anything below 6% without a fight. Freddie's benchmark corroborated what daily surveys showed all week. Rates are sticky around these levels, not collapsing towards the 5.5%. For DSCR investors evaluating whether to wait for lower, this is your answer from the most widely watched mortgage benchmark in the country. 6% is a floor right now, not a ceiling. The question isn't whether rates will be lower in 6 months, it is whether the deal in front of you today can generate the positive cash flow at today's DSCR loan rate. Now let's look at the rate update together with the major economic indicators on how they are affecting your wallet. 30-year fixed mortgage rate started at 5.99, ended at 6.13%. DSCR loan rates ran approximately 0.75% above conventional mortgage rates, which means rental property investors are seeing DSCR loan rates in the high sixes this week, right around 6.88%, moving higher alongside the conventional market. Initial jobless claims, 213,000 for the week ending February 28th, unchanged from the prior revised week and below the 4-week moving average of 215,750. This is a labor market that simply refuses to crack. Steady claims near 213,000 signal that employers are holding into workers, which reduces pressure on the Fed to cut aggressively. That keeps treasury yields supported and mortgage rates elevated. For DSCR investors, there is a silver lining. A tight labor market means strong tenants, demand, and better rent collection, even as it keeps your DSCR loan rates higher than you would like. Your move, lock now or wait for a dip that may never come. Here is the honest analysis. We have now seen 2 consecutive weeks where rates dip towards or below 6%, only to snap back above it within days. That is not a trend towards lower rates. That is a market that has found its equilibrium. The strong jobs data backdrop, steady GDP growth, and Fed that is not rushed to cut are all conspiring to keep mortgage rates and DSCR loans rates anchored in the 6s. If you are closing within the next 30 to 45 days, floating is a gamble that the data simply doesn't support right now. The risk reward favors locking. If you are in early acquisition stages, keep watching initial jobless claims. If that number starts climbing towards 240 or 250, $250,000, it signals labor market softening that could finally give rates room to fall. Until then, the high sixes are your mark. Now, let me unpack the strategy I promise you. Keep your DSCR ratio above 1.2 in DSCR lending. Lenders tier their pricing based on how comfortable your rental income covers the mortgage payment. And crossing the 1.2 threshold is one of the most powerful pricing triggers in the entire program. A DSCR of 1.15 versus 1.22 can be the difference between a 7.25% rate and a 6.75% rate on your next investment property loan. That is not rounding error. That is thousands of dollars a year in cash flow. Before you submit your next deal, run the numbers on how market rents are calculated in your area, because higher appraised rent can move your DSCR ratio in your favor without you putting in a single extra dollar. If you want to explore other strategies that work better for your specific situation, call or text me directly. Our info is in the description below, and I will walk you through exactly how to position your next deal for the best possible prices. And just like that, this is already all news. Thanks for watching. If you found this video helpful, give it a like and subscribe for more expert insight on real estate investing. If you are ready to take the next step or have questions, call or text me at 718-300-3503. I'm here to help you understand the market, find smart loan options, and turn today's challenges into tomorrow's cash flow.
If you want to learn how to use financing to grow your portfolio, check out my DSCR Loan Tips and Tricks playlist. Inside, you'll find powerful strategies, lender insights, and real-world tips to help you close more deals and maximize your cash flow.